Alright, so welcome to this new section in Kotak Stock Shala. This video and this series will explain to you how to find growth stocks and what is all you need to understand growth investing strategy. So first of all, let's understand what constitutes investing returns. Like if any returns you want to make, what are the two major building blocks if you want to make returns? So if you go to the slide, you will understand that your exit price divided by entry price is what is the building block. So you entered at 100 rupees and you exited a stock at 1000 rupees. That means you made a 10x return in that stock. Now, while you would have entered that stock, there will be some earnings per share in that company. Let's say when you bought that stock at 100 rupees, that company was making 10 rupees of earnings. And when you sold that stock at 1000 rupees, it was making 50 rupees of earnings, which means over a period of time, while you were holding the stock, the earnings of that company went from 10 rupees to 50 rupees. That is what this particular block tells you. Now, if you have bought that company for 100 and if the earnings was 10 rupees, that means the price you paid for the 10 rupees of earnings was 100 rupees. That means 10 times of that earnings which you paid for that particular company, which is called PE ratio, price to earnings ratio, which is also a very, very powerful valuation ratio in stock analysis. Now, when you exited that company, let's say the earnings of that company was 50 rupees, which means you sold that company to somebody at a PE ratio of 20 times, because 50 into 20 will become 1000, which means while you are holding the business, the valuation of that went from 10 PE to 20 PE. Now think about it. What could be multiple reasons why this valuation expanded? And that also helps you to understand that the two major building blocks of any company, if you think about investing returns, is first business performance, which is being analyzed by fundamental analysis, and second is sentiment or valuation around that company, which you cannot check just alone with business performance, but it also depends a lot on the sentiment of investors, which is measured by technical analysis. So fundamentals tell you how the business is growing and technicals tell you what is the mood around any company or any business based on its historical performance and most importantly the future performance, because the market works based on what it expects from a stock in future, not in the past. Yes, there is an element of past performance, but market always wants to see what it can do for me in the future, because investing is all about future. You don't care what it has done in the past, more than that you want to learn about where it goes in the future. So the first thing which you need to understand is, if you are investing for a long term, one of the very powerful parameter to understand the compounding is how your earnings growth is completed over a period of time, how it is going in the next 5, 10, 15 years. So let's now try to understand from a growth investing perspective with an example of something called as technology adoption lifecycle, what it means for a company. So any company, when it starts in this innovation phase. It is very early phase and it might be wanting to solve a product and service related things for the business community, right? So it wants to create a product or service which can help customers to solve something in their life. So let's say company like Uber or Ola, why would have they started their company? They would have thought, hey, I want to book an auto or cab. I need to go to a Choraha and actually get a cab driver, or I might need to call that person. He might not know the exact location where they need to reach, or if I have heavy luggage, I need to lift that up and then go to the cab or auto station. So Ola thought that, hey, how can I create a technology where both the things can get connected? Now think about e-commerce business, how Amazon got into effect and how companies like Flipkart came into existence, right? If you want to go for a shopping, you would drive, then find a parking, you go there, you don't find the inventory, you don't find different colors, varieties, and you end up spending a lot of time, wasting a lot of time. And still, there might be cases where you don't find the right product. Now with e-commerce, you can actually go through all the items seamlessly at your home, then order it and it gets delivered, right? So it is a specific problem which that business solves. Now, not every business who is in that early phase succeeds. They also fall into this chasm, which is the blank space in between, which means some of the businesses die, some of the business are ahead of their time. Imagine the mobile application or smartphones were not available when Ola Uber started, or the 5G network, 3G network was not available, then these businesses would not have existed. So you need a right ecosystem, right mindset of people also to adopt that product. Now, once they reach a sustainable phase, which is this phase where you see this blue arrow, it is at a stage where it is just surviving. Probably a small company with few employees, promoter-driven company, founder-driven company. So these founders are running the show entirely. But if they want to expand, they need few elements to exponentially grow in their journey. So they need a right supply chain, they need IT development, they need right processes, right distribution network, and more bandwidth of the management. And they also need to train people so that they can expand very quickly. Now, all these, what we call is a bowling alley, because you need to break these pins simultaneously if you want to achieve that scale in your production. Any one without other will miserably backfire for the company. Now, not every company does this, but if a company is really doing it, you might want to see these companies very closely, because these are the ones who has some potential to grow further. Now, if a company puts all these things together, we call it as a tornado phase, where company can actually go through exponential growth phase, and that is where you make a lot of money. Because in investing, growth is equal to money. If your earnings are exploding, if your earnings are growing, even before that, market will start putting higher valuation into those companies, because now they know that this company has much better future than what it had in past. So that is what drives the stock prices up, that drives the valuation up. And if that earnings really come in and that surprises the estimate, that is even better. And if that earnings continue for a long period of time, it can completely change the trajectory of any company. And ultimately, it gets saturated, and then slowly the stock prices starts falling. So this is the entire cycle. In the next video, what we'll do is we'll try to connect these dots with the earnings, with the momentum in earnings, with the momentum in price, what is stage analysis, and how to actually make sense of this entire framework which we learned so far, where a company from a startup phase to a survival mode to the phase where it realizes all the triggers and the foundation is in place, and then it goes into tornado, how this actually happens, what you need to know as an investor, and what are some of the technical patterns to spot such businesses and identify that you are ready for your growth investing journey. Thank you so much again for watching this video. Let me know in the comment section, how did you like this video, and what were your key learnings around this, and I'll see you in the next video. Thank you so much.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.